But sticking with earnings, let's move on to the next company. Mphasis is on our radar. The stock has been reacting to the earnings fine print that came out. Revenue growth was a little below estimates, but deal wins have been pretty strong, as has been the commentary, and margins have been fairly steady. So to talk about the performance in the third quarter and the outlook, we have with us Nitin Rakesh, CEO, and Aravind Viswanathan, CFO at the company. Gentlemen, thank you very much for joining in. Good to have both of you on. I'm just going to start with the fact that the constant currency growth, Nitin, is just about 0.2%, and the market would have, of course, loved to see more. However, you are talking about record deal wins. So how does it tie up? Was it just sort of some seasonality that hit in the third quarter? And what's the outlook as we look ahead?
Sure. I think the deal wins are at about a 6-quarter high. Pipeline is probably at a record high, up 50% year over year. So I think what that tells you is that the pace of activity is definitely picked up in the environment and in the business. Led by banking and TMT, so something we'd called out over the last 3 or 4 quarters as well. I think there's some work to do across some of the other verticals and geographies. US is definitely doing okay. We have some work to do in Europe, especially as we think see recovery in BFSI back in Europe through 25. Pipeline, as I mentioned, is pretty strong. So are the deal wins. So good news is the order book continues to strengthen. Sequential growth obviously was a little bit impacted by the fact that this was a seasonally weak quarter. And we do expect to recover growth back in Q4 as we round out the year.
Okay, so it was just seasonality in the third quarter. Got it. Now, you've been maintaining that Mphasis will perhaps post better than industry growth. But help us with some sense of what that really means if we're talking FY25, because it's very, very different across different companies. There are companies that are managing to grow at 25-30%. There are large companies that are barely doing 3-4%. So what should we understand by industry-leading growth?
Yeah, I think each company has a different portfolio and a dynamic. Of course, for us, we are in a phase of recovering growth after a fairly tough environment in calendar 22 and 23, driven primarily by the deep cuts that you saw in discretionary spend coming out of the interest rate cycle, partly linked to the portfolio that we've run. So good news is we've seen the recovery of that over the last 4 quarters. And as we define industry growth, it's really the weighted average growth of our peer group across all gap segments. Given where we are, given the remainder of the year, really Q4, that really means you're looking to grow above the single midpoint of the average growth. So basically,
and what's the weighted average, Nitin? What is that weighted average across your peer group?
At this point, the weighted average across the peer group is south of 5%. So I think if you think of that as kind of the baseline, for us the effort has been to grow above that number, and I think this has been a decent recovery in terms of the YY growth number. And as we pick up pace in sequential growth, you will see that pick up as well.
So you'll grow above means what? 1.2 times, 1.3 times? What should it be?
I think at this point, above is where we will be. We've stayed with that through the last year since we started FY25, and we'll leave it at that.
All right, let's focus on margins then. You're currently in the middle of that guided band, but since your deal wins are good, you're going to grow better than the industry as well, and you have operating leverage that will play out. Do you think margins will gradually move towards the upper end of the band?
Aravind?
Quick update on the current quarter, right? So we did 15.3%, which is a marginal drop in a seasonally weak quarter. So we've been operating reasonably at the mid-range of our guidance, right? So that the reason there is a range is that we could operate at the both ends. And I think as growth picks up and some of our investments pay out, I think there is headroom for margin to tilt up. But we'll wait and see how it kind of unfolds.
All right. Okay, all right.
So just to, press you a bit on that margin front, I mean, the band is, I think, 150 bips, right? If I'm not mistaken. So as you're looking at a pickup in discretionary spends, which is what Nitin highlighted, what is happening on pricing? I mean, I don't know if maybe it's too early a question to ask, but when you talk pricing with clients, what's the feedback you get? Is there any elbow room to increase maybe, in some geographies across some contracts, or none at all?
I think at this moment, yes, pricing is a reflection of competitive environment, underlying demand, but it's also a reflection of what segment of the market are you playing in. If you think about, forward-leaning approach that we've taken on a lot of the tech platforms, I don't think the primary issue that we have to deal with right now is the pricing, competitiveness. Yes, we have to be competitive, but I think clients are willing to pay for value. I think the primary rub right now is how quickly can you tap into the opportunities that are being presented by either the current AI adoption, or more importantly, areas where we do have an opportunity to become more competitive using AI. So I think pricing for us we're in a comfortable position. We've seen fairly forward-leaning approach from customers as well when they see value. Focus right now is prioritizing growth, and I think we will continue to hold margins in that stable band. As we get into FY26, we'll give you further guidance on margin as well. But I think at this point in time, 100% focus really is on driving growth.
All right, the AI-led pipeline for you has moved up from around 35% to around 55%. So that's telling us a thing or two about your focus area. Another query that we normally wake up to in the morning, not very company specific, is what's the Fed going to do? And now there is a moderation in terms of expectations, because at the start of this year, you would have thought that maybe we'll get more hikes than what we're currently working with. But what if there is moderation in the Fed's rate cuts? How does it impact your business?
I think, again, it's predicting the bottom of any cycle, especially interest rates with such complexity in the macro, is very hard to do. So what we've tried to stay away from is build a plan or an outlook or a guidance based on where we think the macro will be. The focus has really been more on the micro front. What can we do with our existing clients in our existing geographies and verticals? And how do we really take opportunities that are being presented? And that's the way we've operated the business for the last few quarters since macro became uncertain. It's very hard to predict whether there'll be one more cut, two more cuts, four more cuts. I think anybody who has a good sense is really not 100% confident either. So for us, we've seen some impact of the turnaround in interest rate cuts over the last 3 quarters in the business, specifically in the mortgage segment. It stabilized a lot before that. If there is any additional activity that helps our business, I think that's the upside risk to where we stand today.
All right, just one quick question on your verticals. BFS revenue, that was up by around 8.5% on a year-on-year basis. And insurance as well did pretty well at around, I think, 7% growth. Do you see that growth number gradually moving to the double-digit mark?
I think that is the effort that we've been putting in. We called for a recovery in BFS as well as TMT for 4 quarters ago. I think we're inching close to the double-digit mark in BFS. If you look at our direct BFS growth in Q3, it's almost 10%. So we are fairly confident that that recovery will continue to pick up pace, purely based on the deal activity and the closures we've seen as well. So I think good place to be. And as I mentioned, right, if macro turns more favorable, there is upside risk to that number growth from a growth standpoint as well.
Finally, Nitin, can't let you go without asking about AI and what that's meaning for your business. I think from what our colleague Rima was telling us, the pipeline is at about 35%. In Q2, it was 35%. Now it's at 55%. Can you tell us how that's contributing overall to the revenue and what's the trajectory?
I think the phrase we've used is AI-led. What that means is that a number of opportunities get opened up because you have the ability to use either an AI platform, third party or our own, to actually bend the cost or the efficiency curve, and in some cases create an ROI that probably wouldn't have existed without it. So it's a fairly good place to be. I think the last 2 years since OpenAI launched ChatGPT, there was obviously a fairly high degree of interest at the enterprise level from an adoption standpoint. We are starting to see the pace of adoption really pick up. And I think 25 will definitely be a good year from that perspective. What we are doing is bundling that into a number of our solutions. And that's leading to growth in pipeline. That's supersizing deals as well, actually. And ability to then drive closure is also getting fairly clear. So that's one of the reasons why you've seen a pickup in TCV numbers for Q4. For Q3, we've also announced an additional 100 million plus large deal in Q4 already. So I think that's a sign of things that hopefully point to a resurgence in deal making through the remainder of 2025.
Okay, all right, gentlemen. Appreciate you all stopping by, giving us details with regard to how you see business shaping up, and also sounding reasonably optimistic about growth for FY26. Look forward to having a chat with you all in the next quarter as well. Well.